In this session, let's start looking at the employee compensation, where the focus is on the post-employment plans, more pertaining to the pension plans, as well as during employment plans, during employment kind of compensation, which is more linked with share-based payments like stock options or outright share grants or anything of those kind. So two things there: how do you handle them in the financial statements, as well as how do we get into the valuation processes of each of those kind of payments. That is what we are going to deal in this session. So first, looking at the post-employment plans, which are typically categorized as the pension plans. And in that category, we can very well look at two types of plans. One is a defined contribution plan and the other one is a defined benefit plan. So when I am talking about a defined contribution plan, here the company is not taking care of the pension of the employee, the pension benefit of the employee. Rather, on the other side, it is contributing a constant proportion of the salary or constant amount or a defined amount, need not be constant, proportion of a salary probably, a constant amount or a constant proportion of the salary every year or every month to the retirement account of the employee. So for every month of service he is putting up with the company, some portion is contributed as a pension retirement account of the employee. So depending on the number of years or number of months of service he has put up with the company, the contribution keeps growing and growing. But once this pool is formed and the person retires, the company is not taking the responsibility of distributing this much. This how do you manage this, in what proportion you want to invest, where this is not taken care by the company. Its responsibility is only to contribute some portion of the salary every year to that account. It is not managing the account. It's up to the individual or the employee to bear the risks that are inherent in that particular account, and this particular account will take care of distribution of the benefit once the employee retires until the death, will be taken care by his retirement account, which is not taken care of by the employee. So the employer is only doing a contribution to this, but he is not getting into defining how much benefit would this employee get on the retirement, which means the employee will bear the investment risk for it, and we are not defining any specific benefit which the employee will get on the retirement until his death. And so from an accounting standpoint, it is very easy to account, because from an employer's perspective, he is contributing some amount to some account. That's it. That's where his responsibility ends. Only contributing something to an account. So whatever he is contributing on a monthly basis, that is treated as a pension expense and it is directly put in the income statement. And there is nothing that is going into the balance sheet as a part of this model. So it's a very simple accounting process as far as the defined contribution plan goes. But when we are talking of a defined benefit plan, it's not the contribution that is talked of. It's not how much employee is contributing to an account that is talked of. Here the employer is defining the benefit part. You will be paid this much amount every month on your retirement. This is an amount that you will be paid every month or every year on your retirement until your death. So it's not the amount that I am contributing, it's the benefit, how much you will get on your retirement. So that is why we call it as a defined benefit plan, and generally the defined benefit plans are based on the years of experience. Okay, if you have put 2 years, if you have 2 years of experience with the company, probably 2% of your salary before retirement, it will be worded like this: 2% of the final salary, which is salary before retirement, for every year of service. So because you have put 2 years of service, the pension which you would be receiving is 4% of your final salary before the retirement. Whatever is your final annual salary before retirement, 4% of that will come out as a pension for you every year until your death. That is what is typically worked out as a part of the defined benefit pension plan. So whatever he is contributing, so it's the output which the employer is bothered. So he is not there is